Welcome back to more Fun with Finance. I'm Dr. William Elliott, coming to you from beautiful uptown Shaker Heights. So, this lecture is going to be a little bit different than the textbook. We're still going to be focusing on raising capital, but I'm going to take a few deviations. The chapter itself in the textbook in Ross is fairly self-explanatory. It's a lot of institutional detail and so forth. So I'd recommend that you do read it. And if you have any questions, I always welcome questions, but I'm also going to add some additional material here too that I think you might find interesting. So with having said that, let me get out of the way and we'll get to the slides right off the bat. I'm going to start off by talking a little bit about private equity and private placement. At the back of the chapter, your authors do talk about a private placement. There really isn't anything in particular about private equity in the chapter. So let me describe both of them to you. They're very different animals. First, we're going to start off with private equity. A private equity is a company, and that company is owned by the general partners, and the company can do one of multiple things. One of the more common activities that private equity firms engage in is leveraged buyouts. So they will buy a company that's publicly traded and basically take it private. And they do that by using some of their own capital, but they also load it up with a whole bunch of debt. And this is where the junk bond market, you may have heard of that. This is where the junk bond market comes in because they use very high risk debt to buy these companies. Now, the equity stake comes from limited partners. So the limited partners are these folks, and as opposed to the private equity firm itself, which is actually owned by the general partners. The limited partners contribute capital of their own, and then the general partners go out and they find firms that are likely candidates that, for whatever reason, are not completely most efficiently run. And the goal is to buy those companies, take them private, fix them up, polish them up, and then 3 to 5 years later, sell them somewhere, either through an IPO, an initial public offering. They could be sold to another private equity firm. They could be sold to another company. But the idea is that they're going to do some cleaning up of the company. Most of these companies tend to have fairly low debt levels, large cash flows. Sometimes they'll have a fair amount of redundant assets that can be sold off. They may have poor management, but in general, these private equity firms come in and they fix all of that. Now, the limited partners contribute capital to this, and they're contributing to a particular fund that is part of this private equity firm. All right, so these limited partners only get returns off of this particular fund. There may be other funds over here that other limited partners invest in, but that's a completely separate deal. Now, these private equity funds, they have what are known as portfolio companies. And these portfolio companies are the firms that many of them had previously been publicly traded, but have been purchased by the PE firm, and with the goal to clean them up, make them more efficient, and attempt to sell them, and at the same time make internal rates of return in the 20+% range for the limited partners as well as the private equity firm itself. So that's a very quick view of one of the activities that private equity firms engage in. We're going to talk about two more activities. One of them your authors talk about in chapter 20, and that is venture capital. So private equity firms engage in venture capital. They also engage in funding some what are known as middle market firms, and I'll explain more about that in just a minute. There's another type of private placement, and recognize that these are very separate things. A private equity firm does those three activities: LBOs, middle market funding, and venture capital. Either one of those three, or sometimes they do all three. Private placements are different. These are placements of securities, and they can be equity or debt, that are placed via via an investment bank that's helping the firm that's trying to raise capital. And those companies, instead of placing them in the public market where anyone can buy those shares, they're placed in what's known as a private placement, where only a very specific group of institutions and individuals can purchase those purchase those securities. Companies like insurance companies, pension funds, and wealthy individuals, the word qualified investor. Basically, it means that you're well off enough and you should be well informed enough to know what you're getting into. And that's part of what makes private placements attractive, is that they forego a large part of the regulatory facilities that are run by the SEC. Essentially, the SEC says, look, these financial institutions are wealthy individuals. They already know better, and we're not going to have to worry about it, and they should do their due diligence, and if they lose money, so be it. That's their problem. For the issuing firm, the advantage is that they may get preferable rates, or even they may be able to renegotiate later on down the line, because typically the number of individuals in a private placement are relatively small group of financial institutions are part of this. And these securities cannot trade in the public domain. If you wanted that to happen, it would have to go through all of the extra regulatory safeguards that are out there. So these issuing firms, they avoid an IPO. They incorporate private funds into the financing package, and it provides additional flexibility. About 50% of long-term corporate debt, half of long-term corporate debt, is privately placed. In other words, you and I, if we just go out there and try to buy some of this corporate debt, we won't have access to it. However, we can buy shares in securities that these large financial institutions that buy these things. So, if you're in a pension fund, more than likely that pension fund has access to these private placements, and you can buy instruments that they've created that may have those privately placed securities as part of that portfolio. So private placements are a fairly substantial market, but they're something that you don't hear about a lot. They're relatively quiet, and like I said, the public does not get to participate in them. But that's part of the attraction of them, is that they don't have to go through all the regulatory rigmarole. Now let's go back to private equity firms and hedge funds, for that matter. They both kind of operate in this same realm. In fact, many of the investment banks have a division that does private equity, and they'll also have another division that does hedge funds. So they're all kind of playing in each other's sandboxes. Some features about these institutions: The part of what makes them attractive from the institution itself, from those who have founded it and run the company, is this fee structure. It is very generous. 220 is the typical fee structure. In other words, these firms that are doing LBOs, buying up these companies and fixing them up, and then 3 to 5 years, maybe 6 or 7 in the bad cases, take them public again. They are taking 2% of the assets under management every year, and then 20% of the gains. Substantial benefit for those who run these firms. Many of them don't make enough profit for their investors to actually be better off by investing in them. You usually don't hear about them. Literally, there are thousands of these companies out here, and the vast majority of them you've never heard of, and they're quite small. It's only those very large ones that you've heard of and that actually may do a good job in what they allege to do. Already mentioned about the limited partnership. They pool investors' money. They invest that on the behalf of the investors. And then they also do have, even though they have very generous fee structure for the managers, there are some limitations, right? So there's typically some sort of high water mark. So if the value of the fund goes up and managers get profits and they take that 20%, but if the value drops back down, they don't get to gain again until they exceed that previous high level, that high valuation. They also have long holding periods, these private equity firms. Hedge funds, typically the holding period is in the 1 to 2 year range. They don't like to go beyond that, but private equity firms will go out to 3 and 5, and in some cases they'll have to go out to 6 or more years. And as I already mentioned, they're focused on LBOs, VC, and mid-market investments. Mid-market just meaning firms that aren't really big but aren't particularly small. They kind of fall into this weird category, and they need some additional funding that they're not always able to get, at least not to get at a reasonable price. And in comes the private equity firm to provide those funds. So in terms of venture capital PE companies do just what it sounds like. They invest in startup companies. Extraordinarily high risk. This is a fairly small market. We're talking about something under $500 billion for sure, and more than likely in the 300 to 400 billion range. As of 2019, it was a little over 200 billion. I don't know current figures, but it's not a huge market, but it's a very important market in that these startup companies are really the future of our economy. Individual venture capitalists invest their own money, but that's usually not sufficient. There's usually, as you read in the chapter, they start off with seed money from themselves, mortgages, maybe relatives, friends, known as angel investors. But once they've gotten past that stage and the company still looks viable, then they need more money. So this is where the venture capital PE companies come in, and they're sourcing capital from these groups of folks, individuals, pension funds, insurance companies, other large corporations, university endowments even, and then they invest in these startups. There are usually some fairly stringent constraints and guidance on these things. They don't just hand them millions of dollars and say, go out and do your thing. They put some pretty tight constraints on them. They have to meet specific goals designed to grow that company to the next level before they get the next tranche of funding. Um, Venture capitalists typically provide this through a couple of different means. The names that get applied to this, as your text said, it's stage A, B, C, D. It could also be referred to as ground floor financing, mezzanine financing. Ground floor being the first part, the earlier stage, mezzanine being later stage. Each stage of the financing, the value of the founder's stake grows, and the profitability, or excuse me, the probability of success also does increase. Ultimately, if the company does get to the point where it becomes something that the venture capitalist wants to divest from, then they will try to sell it off. They might sell it off to another company, they might sell it off to another private equity firm, or they might even take the company and do an initial public offering. A lot more about IPOs in just a minute, but that's where a company becomes publicly traded. Middle market private equity firms, as I mentioned before, they focus on these kind of in the middle companies. They're not the massive companies that you know. They're at the bottom end of the S&P 500 and below. Some of the smaller companies in the S&P 500 are quite a bit smaller. I mean, we all know the big companies in that index, but the lower half even are relatively modest-sized companies. It's that top half that really make up most of that index. And the rationale for these companies, they're seeking capital to expand into other regions. They're also possibly a founder who is getting to the point where they'd like to get some cash out to get diversified, buy other investments, not be entirely dependent upon the firm, but they're not quite ready maybe for an IPO. So in come the private equity firms with a pile of cash, and they're able to come to an agreement with these middle market firms. And then the LBO, which is really the origin of the private equity firm. The LBOs are kind of, or at least originally, were the bread and butter. But they, as these LBOs candidates got more difficult to find, then they branched out into venture capital and into the middle market. But an LBO is simply a leveraged buyout. All right. And these have been around for ages, but they weren't always done by these private equity firms. It's only recently that private equity has gotten into it. In prior decades, back in the 20th century, this was done largely by companies or by individuals. Some of these buyout artists would look for companies that needed some attention. Maybe they had a lot of assets that weren't productive. Maybe they had a lot of cash flow, but they weren't being managed as well. They may have had very low debt levels, and so you could crank up the debt. You could suck off some of the cash flows. You could sell off some of those unproductive assets and so on, and make the company much more valuable by doing so. Okay, now we get into the security issuance business. All of these terms, if you just click on one of them, they will take you to Wikipedia or to Investopedia and help define what each of these terms is. Many of them are the same terms that you'll see in your textbook, but some of them are a little bit different. I would recommend that you familiarize yourself with these terms. They're critical to understanding the markets and how they work. We're going to talk about most of them in the next few slides. So when a company is looking to do an IPO or even to do a seasoned equity offering, and again, If you're not familiar with that, you may have heard IPO, but that means initial public offering. That's the first time that the company's stock is traded publicly. An SEO, or a seasoned equity offering, is another equity offering of a company that has shares that are traded publicly. They're just raising more capital and issuing more shares. So their shares outstanding will go up. Couple of ways to engage in that. One is called negotiated, and the other is called competitive. In a negotiated offering, the key difference between these two is that in the negotiated offering, the company makes an agreement with an investment banker ahead of time. And they say, look, we want to work with you. We'd like your advice on helping us go public, do an SEO, do a debt issue, what have you. And then they do that process, whatever it is. A competitive offering, the company that would like to do this issue actually fairly well designs the securities that they intend to offer, be it an IPO or a seasoned equity offering or a debt offering, and then they put it out there. And the variety of investment banks that are interested in it get to bid on it. Say, I'll do it for X number of dollars or for X percent, and so forth. So that seems like a much more effective way. And in fact, of the competitive offerings that we've observed and we see in the research papers that look at these, competitive offerings are cheaper. Not surprising, right? You think about going out to a contractor, you want something done to your house, you get one contractor and you work with them versus going out and getting 3 or 4 or 5 bids and then selecting the bid that fits best. Well, the negotiated is like we just found a contractor that we really love and we'll pay whatever prices they set or whatever we can negotiate with them. The odd thing, though, is that most offerings are negotiated. They're not competitive. So in other words, it appears as though maybe firms are paying more than they need to do these offerings. Now, here's the problem. We don't know the counterfactual, all right? The counterfactual is the firm does a competitive offering. We don't know what it would have cost if it did a negotiated offering, and vice versa. It does a negotiated offering. We don't know what the competitive price would have been. Maybe they did select the cheaper version of it. That becomes quite a tough nut to crack when you're doing research on these things too. If you just look at averages, you're going to say, yeah, competitive. Why aren't they all doing it? But literally 90% or so of the companies do negotiated. It's only a very small percentage that do competitive offerings. Again, we'll see more of this later on, especially when we talk about seasoned equity offerings versus rights offerings. We see the same sort of weird situation where the rights offerings are cheaper, yet firms still, most of them do seasoned equity offerings as opposed to rights offerings. All right, but this is at the outset of figuring out what we're going to issue and who's going to help us do it. What investment bank are we going to be working with? All right, so when we start to sell these securities, there's a long process that's involved in doing an IPO, and I'm not going to go into all the details on that, but I do want to talk a little bit about it. So in an IPO, and you'll also have read some of this in your textbook too, talking about writing the registration and submitting that to the SEC and getting approval from them, etc. But here's a little different twist on some of this. When we talk about an IPO, that trade is taking place in what's known as the primary market. And these typically are primary shares that are being traded. A secondary market trade is a trade. Let me back up. Primary market trades, here's how you define what it is, whether it's primary or secondary. Look at the cash flow. If the cash flows from an investor back to the company and the shares flow the opposite direction, that's a primary market trade. If the cash flows from one investor to another investor and the shares flow from that investor to the first investor, that's a secondary trade. In other words, if the money flows back to the company, that's a primary market, and those are primary shares. If it's just one investor to another, that's a secondary trade in the secondary market with secondary shares. Just to keep that lingo clear. I know it gets a little complicated here. It's kind of an alphabet soup of terminology. There are third and fourth market trades too. Let me get out of the way. There's fourth market. The authors don't really delve into that in your text, but I just thought I'd throw it out there. So if you've heard of those, third market is off the primary exchange, but still intermediated by a broker or a dealer. Fourth market is literally investor to investor. There is no intermediation. And those have been quite a bit more popular lately. You may have heard of the word dark pool. And a dark pool is typically considered a fourth market trade. Dark pools are investor to investor, and you don't know who's in there. That's why they call them dark pools. So let's look at the IPO and SEO market in a bit more detail. So IPOs, stocks have never traded in the public domain. So an IPO company is selling its stock to the public for the first time. Typically, these are small, growing companies that have a great deal of additional capital needs, and their founders want a little bit of extra liquidity, the ability to cash out some of their position in the company. Once a company has IPO'd, then additional shares that get issued are issued in what's known as a seasoned equity offering. Sometimes people will refer to these as follow-on offerings, and sometimes the IPO and the follow-on, the next seasoned equity offering, will actually be set up in advance. They may be separated by months, but a company that's growing very quickly will need that. Seasoned equity offerings can be offered in two ways. And again, you'll notice that your authors mention this in chapter 20. General cash offering is one method, and that's actually the dominant method in the U.S. market. And then another method is known as a rights offer. Basically, the difference is that a general cash offering is open to anyone who's got money and wants to buy shares of this company can submit a offer to purchase, whereas a rights offering is only open to existing shareholders of that company. One of the benefits of the rights offering is that they're less expensive, and shareholders are able to maintain their percent ownership more easily this way. Now we come down to a couple more pair of terms. We've got firm commitment versus best effort. So whether we're doing an IPO or whether we're doing an SEO, there are two primary methods by which we can do these. So we've already selected our investment bank, either through a negotiated offer or through a competitive offer, right? That's the first pair. Second pair of terms is this: firm commitment versus best efforts. All right, what's that mean? Well, a firm commitment basically is what it says. The investment bank that we're working with will agree to buy all of the shares that we as the company want to issue, regardless of whether they can sell them to the marketplace. Now, obviously, they're not going to buy them at a price if they don't think they can sell those to the marketplace. So they're going to do their due diligence. In fact, that's what underwriting is all about. They're kind of out there figuring out, what's this firm worth? What do we think we could sell it for? How many customers do we have that would be interested in it? We put together a syndicate of other investment bankers that have a much broader network of investors that we can sell to. But the bottom line is that once they agree upon price, the investment banker, the intermediary, buys the whole thing, lock, stock, and barrel, and then gives the cash to the company, and the company goes off and does its thing. It's the investment bank that's on the hook to sell these shares. Now, in the case of a best efforts offering, the investment banker or the underwriter says, yeah, they still help with the pricing and so forth. But basically, they say, we'll help you sell these shares. We'll create a syndicate. We'll look for investors that are interested in it. But if we don't sell everything, you don't get all the cash. Now, here again, just as with negotiated versus competitive, obviously firm commitment is more expensive. The investment banker is taking on a lot more risk. And believe me, in the global financial crisis, they got stuck. There were a number of investment bankers that got stuck with shares when things started to fall apart. And so, it is a real risk. The other odd part is that most issues are firm commitments, the more expensive method. Maybe the companies figure, hey, we don't want to mess with it. We just want the cash and we want to go off and make widgets. That's what we know how to do. Let us go do it. You worry about the financial side of it. Maybe that's it. But again, it's fairly lopsided. Most offers are negotiated, and most of those offers are firm commitments rather than best efforts. All right, primary market and the rest of the story here. I think I've really talked about this, so I think we can continue on. Here's an example of a tombstone ad. These used to be, when we had paper Wall Street journals, it would be the full page of the Wall Street Journal. And it would advertise the company that was doing an IPO or an SEO, and you would see, the total number of shares being offered, the price, types of stock that's being offered. Here we also are told that a portion of this is an international offering. Only 9.2 million are offered in the U.S. offering. Over here on the right side, actually, this part would be below this part, and that's it's vertical. That's why it's a tombstone. It looks like those old marble tombstones. But over here, what you see are the investment bankers, and this is the syndicate. So this is a group of investment bankers. They're not any one of them taking all of the risk. They're spreading the risk among their friends and fellow investment banks. So the other thing to note here is that you'll notice a different font and of these four, and they're all at the top. And then you'll notice that these guys are in a smaller font. Now, it does look like these are just alphabetical. So Bear, Credit Suisse, Merrill, and Witt Capital, those are the lead underwriters. Sometimes it won't necessarily be alphabetical, and the primary lead will, have even bigger font. If Goldman Sachs were in here, Goldman Sachs would always be at the top. They don't take the back seat to anybody. That's just the way they operate. So these four bankers, they're taking the bulk of the risk, and they're doing the bulk of the heavy lifting, the underwriting portion of this particular offering for the World Wrestling Federation. It's this group down here. These are basically the distribution network. So they're not really pricing it. They're not, looking for what the value of the company is. They're simply there to help distribute X number of shares. So, for instance, Jefferies probably has an agreement that they would sell, up to 100, 150, 200, 300,000 shares. And they would get a particular percentage or a fee for that activity. But this ranking is very important to the investment banks. It's kind of like a pride thing. That's why when you think about Goldman Sachs, that's why they're always at the top. They don't ever take a back seat to anybody, no matter who they are. Here's a video that I'm going to let you watch here. I'm hoping that the audio will work. And this is an interesting discussion. It's a bit dated. Nevertheless, it's an interesting discussion because unlike what I've just been talking about, which is kind of the traditional way to do an IPO or even an SEO, they're talking about yet another method, and this is a method that Google actually was one of the most successful of these. This is called a Dutch auction as opposed to a normal negotiated firm commitment type of offering. So let me get this.
Our next guest in today's Google Fest is the CEO. This guy is such a hoot. Is the CEO of Overstock.com. They went public the Google way. This is Patrick Byrne, the larger-than-life Overstock.com CEO. Patrick, given the fact that PET, which also worked, and Overstock came public this Dutch Street way, I mean, can't we just say, what the heck? It's certainly better than the way that they did it before.
Absolutely. This is hands down a better system. It's a better mousetrap. It's not ambiguous. It doesn't trade anything off. People are going to look back in 3 years and say, how did the conventional Wall Street system last as long as it did?
Why is it so much better?
Well, because the conventional Wall Street system is corrupt.
Right. Thank you.
Yeah, well, it is corrupt.
Well,
you know, Jim.
I thought I was the only one who ever said any stuff like this. I hope my dad's watching. I was like throwing the rocks. Like, go ahead, man.
Why is this better?
It.
I can explain it in 3 points. First, as a general principle, anywhere in human affairs that there's guaranteed profit to be allocated, there's kickbacks. Doesn't matter if you're talking about some third world customs official or a white shoe Wall Street banker. It happens. Secondly, the conventional system guarantees profit. They get the heat going about the stock, then they underprice it, shovel it to their buddy in some sleazy hedge fund.
You gave a Lexus example once.
Yeah, well, it's true. Well, you guys always cut me off when I start talking.
No, you got the ball.
Okay, if I had a Lexus, no, you have a Lexus, Jim, and it's a $30,000 Lexus. You hire me to...
No, it's actually 60, but that's
okay, $60,000 Lexus, you hire me to go sell it for you. I take it out, and I sell it to a buddy of... You hire me to go sell it. I sell it to a friend of mine for $30,000 instead of 60, then he turns around and sells it for 60. You know, have I defended your interest?
No.
And now
But that's what Wall Street does all the time.
So what they do all the time, and now what if it turned out that my buddy actually had me come over the next day and I mowed his yard or something, gave me 10 grand to mow his yard? It's clearly a payoff. That's how the whole system works. So the handbrake system, because it's an auction, doesn't allow that sort of guaranteed profit to be allocated. And that's why the conventional old boy system hates it. And people are going to look back and say, gee, why did we ever put up with that for so long?
I think you're totally right. We've been doing it with this one way for 100 years. Let me ask you something, Patrick. You're Elliot Spitzer, okay? There's a cartel that sets the price between 6 and 7%. This deal, doesn't it show you that the cartel is a useless, monopolizing entity that extracts wealth out of people who typically only go through it once and therefore don't know any better?
Absolutely, and I think that's probably an insult to cartels. I mean, these people are worse. I had people threaten me that if I went with handbrake, I had all the banks tell me, I'll work with any other bank, but if you go with Hambrecht, we'll never pick up analyst coverage on you. That was one of the ways. I don't negotiate with terrorists. As soon as they told me that, I said, I'm going with Hambrecht. But Elliott's, it's a useless cartel that extracts rents by shoveling underpriced IPO allocations to their buddy in some sleazy hedge fund, and then the hedge funds give them the kickbacks. That's why in the last couple of years, you've seen these banks paying $100 million and $1 billion fine in one case, and there's one guy who's on trial right now in New York for doing this stuff.
Mr. Byrne, let me ask you this. A lot of folks have said, oh, if we had Dutch auctions, this would avoid the bubble. I understand how a Dutch auction will make sure that the company gets a lot more money that they left on the table, but doesn't this also make a lot of individual investors possible to be suckers and getting in really early and paying way too much at the beginning, just like they did back in 1998 and 1999? There's not going to be anything preventing them from getting in.
Well, I understand your point, but what the individual investor who thinks they're going to get in on some IPO that's going to triple in the first week, they should stay home because it's not going to happen. If there's that kind of demand, to begin with, the auction is going to find it, so you're not going to get a big triple. Now, I've worked with Hambrecht. I did it once. They will price in a 5 to 10% tailwind, so everybody understands it comes out of the gate and it trades up a bit, but the guys who are in there to get a flip should stay home because they're not going to get it. Therefore, the only people who bid should be the people who understand the business, like it. They're not getting in because they think they're getting some piece of paper on an uptick. They're not day traders. They're people who understand the business and think that it's a reasonable price.
Thank you, Patrick.
Thank you for having me again.
Man, don't ever change. Stay the way you are. They haven't gotten to you yet.
Never.
Patrick Byrne,
Thanks for
CEO
having
of
me on.
Overstock.com. Thanks so much.
So, yeah, Patrick Burns is definitely a larger-than-life character. Some of the things he said in there were not too far off the truth, but many of the things he said were grossly exaggerated. This whole idea of the Google way, the Dutch treat, as they were calling it, basically what a Dutch auction does is, and this was when Google went public, if you went to the Google search page, they had another little link right below the search bar that said, hey, do you want to buy some shares of our stock? Make an offer. And you could submit a private offer with specify the number of shares and the price at which you would buy those shares, and then that would go into a list. So what they do is then they would take that list and they would order it from the highest bids all the way down to the lowest bids, and the number of shares would be off to the side of each of the bids. And if they wanted to sell 1 million shares, they would go down that list until they were selling 1 million shares, and then they'd go across at the price, and that price is the price that all 1 million shares would sell for. Even if you offered a lot more, you'd actually get that price. And the beauty of the Dutch auction, and this has been studied extensively by economists, because they're always interested in figuring out what type of auction yields the best price, the fairest price. Well, the reason that they're kind of thinking, leaving money on the table is that incentivizes me to give them a true value that I think the company is worth. If I wasn't going to get potentially a better deal, I might try to hedge downward my estimate of value, right? But if they're telling me, hey, if you hedge downward, you may not get an allocation at all. But if you tell us your real value, even if it's up here, you'll get the low price, the lower price, no matter what. So it is a really good and effective means of finding the value of something and leaving less money on the table. The problem with it, though, is that it's not always something that can work. Even at the time that Google was going public, Google was very well known. It was a household name even in those days. And you get a small company that nobody knows, there's no advertising about it. How is anybody going to know what it's worth? Nobody really has a clue. So although Burns thought that this was going to take over the world and drive all the investment bankers out of business. Notice that the date on that video was 13 years ago. Hasn't happened yet. Now, I'm never one to say that because something is in existence that it must be efficient. No, don't misunderstand me. But what I am saying is that not unlike other markets, take the real estate market for example. Even recently, the real estate market has been roiled by some court cases about fixing of commissions. Is that going to end the real estate market as we know it? No, I don't think it is. Will it possibly change their fee structure? Maybe. But there still will be brokers who charge a very high fee. Part of it is that the broker has to cover their costs. And if they're doing a lot of open houses and doing a lot of advertising, photographs, showing the house, that costs money. That takes time. And there's no guarantee that that broker will get that sale. It's money out of their pocket. The other thing to think about is that presumably the broker is more informed about the market and may be able to get a higher price. So paying that higher commission might be worth it. All right. Let's keep moving on here. A little bit about some of the terminology. We're going to deviate quite a bit from the chapter here. We're going to look a little bit at markets, and in particular the NYSE and the NASDAQ, and a little bit about indices as well. Like I said at the beginning of this video, part of my rationale for doing this is that that chapter is fairly easy to understand, and certainly if you have questions, feel free to reach out, but I thought I'd give you a little additional material here to that might be of interest to you. This is really more of an investment perspective. When we talk about trading on the secondary market, we are talking about the NYSE, the New York Stock Exchange, or the NASDAQ. And a couple of terms that you need to understand when you are trading. Many of you may already do some trading, but there's a bid price and there is an ask price. So the bid price is the price at which the dealer or broker will buy. This is the buy price for the dealer. But if we're on the other side of that transaction, that's the price that we're selling at. The bid is always lower than the ask, by the way. The ask price is the price at which the dealer will sell at. And again, we're always on the other side, so that's the buy price for us. So we're buying high, selling low. Now, spreads are very small typically, and in the current market, they're extraordinarily small. They're, pennies on $60, $70, $100 stocks. There's still very slim margins between the bid and the ask. And that's really the revenue stream for the dealer or the broker. That's how they make their living. Now, this bid-ask spread is the term that gets used to show the difference between the bid price and the ask price. Like I said, on the very liquid stocks, very high volume stocks, we're talking pennies. As volume decreases, though, we're talking about larger spreads. The bid-ask spread gets larger. Another thing to think about when we talk about spreads is where does that money go to? Why do the dealers and the brokers get this? Well, you can kind of think about it from a couple of perspectives. If we look at it, think about order processing. Somebody's got to be there to take the order and run it through the exchange. Now, again, in today's market, that is that's an automated system right now. So it's relatively cheap. That's why, and that's also why spreads are so narrow. Inventory. Dealers keep an inventory. So they've got money at risk. And as the value of the stock goes up, their inventory goes up. If it goes down, the value of their inventory goes down. So they've got something at risk. And then this last component is an interesting thing. It's called the adverse selection component. So the adverse selection component is that piece of the spread that is there to kind of insulate the dealer from better informed investors. In other words, if they all of a sudden get a lot of sell orders, I'm wondering why are so many people selling? Well, they might be selling because they know something that the dealer does not know. And they like the price that they can sell at. Well, all of a sudden the dealer's going to go, well, maybe I need to drop that a little bit. I'm getting too much of a selling. I'm getting too much selling going on here. Or maybe there's a lot of buying, meaning that maybe investors think the price is relatively low. And so then the dealer is going to bump up their quotes. So this adverse selection component is kind of a little extra piece that protects them when a trader who is better informed than the dealer approaches them. The dealer doesn't know who they're dealing with, who they're trading with. They simply know that they've got somebody who wants to trade. And this is a component that is, I would say, non-trivial. This is particularly important for companies that have a fair amount of asymmetric information and are difficult to value. All right, let's look a little bit more in more detail about the NYSE. That is, of course, is the New York Stock Exchange. The NYSE has occupied the building at 11 Wall Street since the early 1900s. Long history of this institution. It went public prior to 2006. It was a partnership. So when you owned a seat on the exchange, you were a partner in that operation. In 2006, just like all the companies listed on the NYSE, it became a stock corporation and was traded publicly. It is now currently owned by the Intercontinental Exchange, i.e. ICE. There are historically there were 1,366 exchange members, and these seats could be bought and sold. So you could sell your partnership as prices went up into the millions. But then when trading was not such a hot item, they could drop well below $1 million for seats. Now, there still are 1,366 seats, but instead of owning it, instead of that being part of the partnership, you pay a fee to the corporation. So that's as of 2015, I don't have an updated value from this, but as of 2015, that seat would set you back $50,000. And this, too, is something that has been long-standing on the NYSE. There were a group of dealers called specialists that's what they did. Was their exclusive job was to make a market in a particular security or in multiple securities. And the specialists had a great deal of obligations to the exchange. They could not front run. They could not go in front of other traders or other trades. They had to make a market. They had to stand ready to buy and sell out of their inventory. They also had to make sure that the market price did not fluctuate drastically or whipsaw, a relatively stable movement from one level to another. And for that, for those obligations, the exchange said, well, we'll give you a kind of a first look at the order flow that's coming into the exchange on the computer systems at that time. And so the dealer would literally have a computer in front of them that showed the order flow. And so they would have a better sense of where the market was moving to before anybody else would. Now, today, we all can have access to that. The specialist is no more. It's now a designated market maker. It's a very different market. But the specialist played a very important role in making the market a stable and reliable place to trade. So these new, the replacement for the specialist is referred to as the DMM, or the designated market makers. There are also some other ancillary roles, the supplemental liquidity providers, the SLPs. But the DMMs are kind of the replacement for the specialist. However, the DMMs are not obligated to stand ready to buy and sell. They don't have to quote all the time. And they still must, make an orderly market to the extent that they can, but much less obligation. And they also have fewer benefits and perks, but they still are there as the kind of the central spot for trading in a particular security. And I think I'm going to jump past this. This is some additional detail that it may probably be a bit more than you'd like to dig into, but you'll have the slides if you want to read through these. Some of the other participants on the floor of the exchange, we've got commission brokers. These are NYSE members that are trade for a particular firm that is that has a seat on the exchange. So they buy and sell for that firm. There are also folks called floor brokers, or AKA $2 brokers. They're free. Think of them as free agents. They work for whoever needs the extra help. So if the commission brokers for a particular investment bank or brokerage house are overwhelmed with orders, then they bring a floor broker in to help out. And then finally, there's another group of traders who actually just make a market for themselves. They have a seat, and they're trading on their own account. They don't trade for anybody else, and those are known as floor traders. And again, here, I'll leave these slides for you to look at, but this is getting into some of the details of the computer systems that are on the floor. They keep upgrading. One of the interesting things about the NYSE is that there's this co-location of their computers with some other traders who want very quick access to the data. So these are known as high-frequency traders, or HFTs. So the high-frequency traders, to them, they're trading not with humans, but with algorithms, and those algorithms are looking at data in milliseconds. So that's 1/1000th of a second. To them, being located in the same room as the computer that runs the NYSE system gives them an advantage. They're able to know what's happening before anybody else does. Literally in Cleveland, if you were trying to trade and beat the market to a particular new piece of information, say the Fed announced something, and you thought, boy, I can get right in there and make a trade and make some money off of that, get in low as it runs up or short as it's going down. You're dealing with history. You may as well give it up. We are so many milliseconds behind the HFTs and even people in New York that it's pointless. That's one of the interesting aspects of the exchange, is that there is this drive towards faster and faster closer and closer computers to the exchange computer. In fact, even to the point where if you were located in a different spot in the room, you might have faster access. So if you're right next to the exchange computer versus on the other side of the room from the exchange computer, that the first party would have an advantage over the party on the other side of the room. So the exchange said, you know what? Actually, we're going to solve this. We're going to give everybody who's co-located with the exchange, we're going to give them the same length wire from our computer. So even if you're right next to the exchange computer, you've got a cord that may be 50 or 100 feet long, regardless of how close you are, so that you have the same delay that somebody who's on the other side of the room has. So all of this becomes quite important. I'm going to skip over a couple of these things. Let me just touch on this briefly. In 2015, there were 2,800 companies listed on the NYSE. It represented nearly 30% of the world's equity trading. A pretty substantial amount. Now, to be listed, you have to meet some particular requirements. So down here are a few of them. You have to have at least 2,200 shareholders. You have to have at least 100,000 shares trading in a given month. The number and value of shares held in public hands has to be at least 100 million in market cap, and there has to be at least 10 million in pre-tax earnings. If you don't meet these things, these requirements, and you're listed on the exchange, they will delist you. You are removed from that exchange and you have to find a new home. Another one of the requirements is that your share price is greater than $5. Oops, I'm just going to put that over there. And if your share price drops below $5, again, you will be delisted. And that's kind of a bad signal. You don't want to be that company that gets delisted, because all of a sudden liquidity goes away. Your price may continue to decline as a result of this additional bad news. Well, let me mention briefly something about order flow, because I think it's interesting and relevant to all of us. A company may be have a primary listing on the NYSE, but in today's world, that company can also be listed on multiple other exchanges around the world. And when we go to trade, whether you're trading with E-Trade or Robinhood, you know what the commissions are there, right? They're zero. The reason that those companies can actually offer zero commissions to us is not because there's no value, there's no cost in creating that trade. No, there's a lot of cost. Even though it's not humans necessarily, it's computer systems and some backroom operations that have to take place. But the way that they do this is that they get payment for order flow. So let's say it's the Philadelphia Exchange that's trying to build up its volume in a particular stock that's listed on the NYSE, and they go to Robinhood and they say, you know what, if you route 500,000 shares of trading through our system every week, we'll kick back X number of dollars to you. All right, so Robinhood says, great, we'll take the deal. And that allows them to offer those of us that trade with a particular brokerage house zero commissions. That doesn't mean that we're getting the best execution, and this is why I bring it up. Most brokerage houses will allow you to actually specify the exchange that handles your particular trade. If you look at your page where you place your order, you should be able to specify if depending on the stock, if it's IBM stock, you can specify that it be traded on the NYSE. NYSE always prides itself in having a better price, meaning that if you're a buyer, it's lower. If you're a seller, it's higher. Better price than is found in other exchanges, even though theoretically they should be the same. They don't all track exactly the same, and there's potential that you might get a trade inside the quotes. So as a result, even though the brokerage house may prefer to route you somewhere else, you can actually specify, and you may get better price execution. I won't tell you that you should do that, but certainly do a little digging on your own before you just let the brokerage house route your order wherever it wants to. Here's a shot that I did back in 2019. We took the undergraduate finance majors to New York City, and one of our stops was, of course, the NYSE. This floor is barren compared to the last time I was there prior to that, and that was back in 1997. So over 20 years prior, I was there, and the place was jam-packed with people, shoulder to shoulder, paper everywhere. Still the computer screens, but not quite as sophisticated. And so the exchange has changed greatly over the last 2 decades, 2.5, 3 decades. A lot more online trading. Most of the trading is through the computer systems and through algorithmic trading. The floor brokers, the floor traders, the commission brokers, the DMMs have very little to do these days. In fact, here is a photo from the floor, and actually the DMM, this GTS is the company that they work for, and there are several companies that provide designated market makers. But you see this gentleman, just kind of hanging out, and this is right before the close on a long weekend. So it's a very far cry from 20, 25 years ago when this place would have been a madhouse. Everything that's happening, it's happening right here on these screens, on the computers. And the face-to-face market has virtually gone away. Right now, I would argue that this is very much a TV studio, just to kind of keep the NYSE's name out there. All right. Circuit breakers are a feature of markets that are designed to try to avoid some price spikes, in particular downward moves in prices. So when prices start to fall, these circuit breakers kick in. It's just like in your house. If there's a surge of electricity on a particular circuit, the circuit breaker will shut down that circuit and cut the electricity off to prevent from overheating the wires and potentially catching something on fire. Well, these circuit breakers do the same thing. They just halt trading, and the type of halts are slightly different depending upon what's going on. There can be a circuit breaker on a particular stock or on the market as a whole. But what they do is they basically call kind of a timeout. And, let's regroup everybody, put the flags up, let everybody know that something's happening over here with this stock or with this market. Bring some money because there might be some deals. And it also allows people a little bit of a cooling off period. It forces the algorithms to stop trading. So if it was driven by an algorithm, it fixes some of that and prevents that from driving the market completely into the ground. And in fact, these circuit breakers were actually increased in their sensitivity as a result of what was known as the flash crash. But they still didn't stop it entirely, and in fact, the thresholds that would trip a breaker were changed as a result of the flash crash. Let me show you just briefly here. So here's the Wikipedia page on the flash crash. It was back in May of 2010, and basically this picture right over here gives you the whole story. That was an incredible day. All of a sudden the market was, humming along at 10,008. Note now where the market is, we're approaching 40,000. So even a short, we're only talking 14 years ago, and the market is well, very close to 4 times the value it was then. So, but nevertheless, it was humming along here at about 10.8, and then literally within minutes, it lost 1,000 points, or nearly 1,000 points. The entire market just went nuts. Nobody knew what was happening. Why did this occur? There's still a little bit of debate about exactly what happened, but and ultimately, the flash crash was at least allegedly caused by one individual in particular, and they eventually were taken to task 5 years later. And yet, there was still, great debate about, whether indeed this Navinder Singh Sararo was actually the only problem. I think many people believe that may have just been a trigger, and that the algorithmic trading actually drove a large part of this as well. But nevertheless, these circuit breakers are intended to stop this sort of thing. They don't always do their jobs, or they're not always sensitive enough to stop it. All right, so let's see. A couple of brief stops here on talking about different types of orders. A regular market order is just an order that you place and say, buy this stock. The key thing with a market order is time is of the essence. In other words, I want to buy this stock, and I want to buy it right now, as soon as you can possibly execute that trade, or sell, either way. So emphasis is on time. The other primary type of order is known as a limit order. And there the emphasis is not as much on time as it is on price. So I might place a limit order to buy at a particular price. Let's say that a stock is trading at 188. I might place a limit order to buy at 185. Now that order will not execute until the price moves, if it ever does, move to 185. When it hits 185, then my order is in line to execute. Even if it hits 185, it may or may not execute my order, because there may be others with orders at 185, and there only may be a limited number of shares that trade before it goes right back up. Likewise, with a sell limit order, you set a price above the current market price. You say, hey, it's at 188, but I'd be willing to sell at 195. Well, if the price never gets there, you never sell. If the price does get there and keeps going, you sell at 195, and it might go to 205 or 210. But limit orders have their uses. They're quite a useful device if you have another position and you'd like to protect gains that you already have embedded in a position, and you don't have the chance to follow the market on a minute-by-minute basis. You can place a limit order. Stop orders and stop limit orders, at least on the NYSE, are no longer available. So I won't mention those. The two dominant types of orders, though, are your market orders and your limit orders. I've already talked about that. And then just a last item here to talk about is the NASDAQ, which actually used to be an acronym. It is now a name. Notice that these are lowercase letters. It used to be capital NASDAQ, which stood for the National Association of Securities Dealers Automated Quotation System. Now it's actually a word, NASDAQ. And the NASDAQ has been around. It used to be kind of the market that you would go to if you couldn't get listed on the NYSE. Now, with the tech boom, many of the largest companies in the world are listed on the NASDAQ. They're tech companies. They started on the NASDAQ, and they've just stuck it out. The NASDAQ is ahead of the NYSE in terms of being computerized. It's all computerized. Always has been. There is no face-to-face location. There is no physical face-to-face trading floor. Obviously, they have physical locations with all of their with their mainframes and their computers, but there is no actual face-to-face location like with the NYSE. The NASDAQ is highly competitive with the NYSE now and has a significant volume. One thing to be aware of, though, is that actually NASDAQ volume is slightly overcounted because they count a trade in a different way than a trade is counted on the NYSE. You can get live quotes from the NASDAQ. You can actually pay to get a more detailed version of quotes. Quotes being what the dealers or brokers are offering to buy, or I should say just the dealers are providing quotes, sorry, not brokers. What the dealers are willing to buy a stock at and what they're willing to sell a stock at. And then I think the rest of this, just skip over the rest of the NASDAQ stuff there. You can go back and review the slides if you like. And then finally, I'm going to end this chapter on a little bit, a brief comparison about different types of indices. I won't go into how to calculate the value of the indice or how to change it if there's a stock split or a company change. But I do want you to know about a couple of things related to indices. The most widely cited indice is the Dow Jones Industrial Average, or the Dow 30, because there are 30 stocks on the Dow. They're all very large stocks, but they aren't, they don't, just because there are only 30 of them, they don't capture a whole lot of the U.S. economy. They capture a large fraction of it, but not the same amount as, say, for instance, the S&P 500. So here are, as of, let's see, I don't have a date on this. Sorry about that. But these companies do change on occasion. This is selected by by a committee at Dow Jones Dow Jones. And so here's a list of the Dow 30 companies that I'm sure all of you know quite well. The big thing, though, here to note about the Dow Jones Industrial Average is this. It is a price-weighted index. And by price-weighted, what I mean is that to construct the index, you would simply buy one share of each stock. And that portfolio, one share of each and every stock, would track exactly the Dow Jones Industrial Average. So when you buy one share of stock, for instance, when you buy one share of, let's say it's Goldman Sachs, you put $188 almost into that one. Okay, so you got a sizable chunk of money into that one compared to, say, Cisco Systems. You only put $30 into that one because the price per share is only $30 at that time. Another low price stock, let's see, Intel, $34 at that time. Pfizer, $35.64 at that time. But you're going to put 114 almost into Travelers. You're going to put 146 into Boeing, 157 into 3M, 140 into IBM, and so forth. This doesn't make a whole lot of sense. And in fact, if you have a very high price stock, certainly you think of Warren Buffett's Berkshire Hathaway, that is in the hundreds of thousands of dollars, 375,000, 400,000, in that neighborhood right now. That would never be on the Dow because it would completely dominate the Dow. So the stocks that they include are limited. So, you look today, there are some stocks that are trading in the thousands of dollars, not tens of thousands, but, $1,000, $2,000, $3,000. Those stocks the Dow would probably never select them. Or if they did want them in the index, they would probably ask them to split their shares somehow. And it just seems rather absurd to have an index calculated this way in today's world. Now, back when the Dow was first created, back in the 1800s, it made sense because it was very easy to calculate. It was very easy to track. But in today's world, it just doesn't make much sense. The S&P 500 is the index that we would really want to use because not only is it 500 companies instead of 300, not only is it 500 companies instead of 30, it's also what's known as value weighted. So instead of by buying one share of each stock, what we do is we put our money into each stock proportionate to its market cap relative to the market cap of the entire index, all 500 companies. So even there, you still have some, very large companies like Apple takes up multiple percent of even the S&P 500 because it's just so massive, even on a value basis. So you put a sizable chunk of money into a single company. But at least it's based upon the size of the company, which is related to its impact on the economy. And so I've always argued that the S&P 500 is really the index we'd want to track if we're looking at trying to figure out what's going on with the economy. It's not that these indices deviate that far from one another, but they do deviate. And there is, at times, there can be significant differences between what the S&P is doing and what the Dow is doing. Anyway, I think I will leave it at that for this chapter. And if you have any questions about this, feel free to look at the slides or get in touch with me, and I'll fill in any details that you might be interested in about this stuff that I'm covering here that wasn't in the chapter. Thank you.